All right. So lucky me that this is actually as fresh as today. The company Tapestry, ticker symbol TPR, just released their Q1 earnings. And so it's as recent as a couple hours ago. So right out of the gate, I am long Tapestry to be very clear. And I'll put that in the description box below. I am long the shares of Tapestry. But I still got to put this through the ringer of intellectual sincerity. So I got to see how the company's doing. I'm going to do my best to give as unbiased a look as I possibly can. Now, this is in their most recently filed 8K, their fiscal 2021 first quarter results. Gross margin increased by 3%. SG&A dropped a sincerely large amount. And operating margin expansion year over year. GAAP operating income was $202 million versus $52 million a year ago. Non-GAAP, I will ignore that just because I don't like dealing with non-GAAP metrics. I want to deal with what metrics are permissible by GAAP rules. GAAP EPS was 83 cents versus 7 cents a year ago, and that's a very large jump. So immediately I'm going to look at this and go, well, now I got to ask some questions. The new CEO, whose last name I will not try to butcher on video, mentions they're very happy with the first quarter results and deliver strong profit growth across the portfolio of brands in face of an unprecedented challenging backdrop. They don't address COVID-19 by name. Not yet. They do that later in this report. They drove a meaningful sequential improvement in top-line trends supported by strength in their digital segment and China. And they expanded gross margin by deliberately reducing promotional activity and raising AUR while also tightly controlling SG&A expense. They've achieved a significant increase in EPS and generated positive free cash flow. So immediately they're trying to appeal to investors, is at least what I get out of it, because we want to see high EPS and high free cash flow. Now, granted, they need to earn that. They need to earn the favor of the crowd right now because they had not been doing so well recently. Now, over here, they mention double-digit year-over-year revenue growth in mainland China, significantly expanded gross margins by over 300 basis points, driven by lower, more disciplined promotional activity. Now, you don't really see luxury goods companies doing a whole lot of promotional activity. So this sounds like they're trying to go back a little bit to their luxury goods roots. You don't see, Gucci slapping around promotional activities left and right. You don't see them doing ads, not a whole lot. So this I like to see this. I hope that's a long-term trend. They reduced their run rate corporate headcount costs by 20%. They've dropped SG&A 27% on a reported basis, increased EBIT margins by over 700 basis points. Tightly managed inventories are well positioned heading into their holiday quarter, which is going to hopefully be a solid source of cash for the company. Generated positive free cash flow of $64 million. We'll see about that. I don't know how they're calculating it, but I'll find out. I'll find out on my own. I'll calculate it on myself. And then you scroll down here a little bit to their acceleration program highlights. They recruited nearly almost 1 million new customers in North America. I don't know how stable that customer base is, considering people are still probably living off of stimulus money a little bit. I want to know how consistent that new spending may be in the future. They are growing in China. They have a very large presence in Asian countries, or they're pushing for growth in that area. Leverage data and analytics to optimize their marketing messaging, assortment planning, and promotional levels. Made further progress in creating an agile and scalable operating model. They're trying to optimize their global fleet with 15 net store closures in the first fiscal quarter, representing a decrease of 50 stores from the prior year. And they want to achieve a gross run rate savings of $300 million, including gross savings of $200 million realizable in this current fiscal year. Now, the overview gets a little more depressing. Net sales dropped by 14%. Gross profit totaled $830 million. Gross margin 70.8. Gross profit last year was $914 million, with gross margins of 67.3. It's just them reining in their costs, which is good. I want to see that. I do. I want to see lower costs and see better operation from the company. But this is still it's still a drop. Now, on a non-GAAP basis, gross profit in the year ago totaled 919 million. Excuse me. 919 million, lost my place, with gross margin of 67.6%. SG&A total 628 million on a reported basis, 53.6% of sales. Operating income 202 million on a reported basis. EBIT margin 17.3% versus last year, which was garbage, and EBIT margins of high octane trash. Now, net interest expense grew rather precipitously. So we'll calculate out the growth. Very simple. 58% growth in net interest expense. Now, they did mention that they drew down on their revolving credit facility to get through for COVID-19 and have cash to be able to run the business. Okay, I understand. Yeah, this is not exactly an easy time to guide a luxury goods company through, or any company through. So understandably so, they had to draw down on some debt. Fine. Nothing, I'm sure, that the new CEO cannot manage. Net income for the quarter was 232 million. EPS, diluted EPS, 83 cents. The reported tax rate for the quarter was negative 25%, reflecting the benefit under the CARES Act, their NOL carryback claim. So right out the gate, I'm just going to look at this as a one-time boost, which leaves me a little itchy as a shareholder because I want net income to be good on its own rather than with the support of an NOL carryback claim. Now, that's why I'm doing this video, to show these earnings are a little fuzzy. As a long-term shareholder, I'm still bullish on the luxury goods industry, and I think Tapestry is going to be great. But in the short term, it's going to be a little ugly. Inventory dropped 811 million this quarter. Last quarter in the year ago period was 880 million. And then you get to segment information, and Coach gross sales dropped 9%. Kate Spade dropped 21%. Stuart Weitzman, I have no idea why they did that acquisition, to be quite honest with you. Gross profit dropped 35%. These segments are not doing very, very well, at least right now. Granted, I have to keep telling myself COVID-19, but that's not as redeeming as I wish it was. Not anymore, at least. Coach's gross margins are still very high, 73.7%. Gross margins for Kate Spade, 64.1%. Stuart Weitzman, gross profit margins, 55.3%. So these segments are still economically profitable. Operating income for Kate Spade, 23 million on a reported basis. EBIT margins of 9.6. Last year's, in the year ago period, EBIT margins of non-existent. And Coach's net operating margins, EBIT margins were 30.8% versus 20.7% in the year ago period. Coach is their strongest segment, no matter what. Stuart Weitzman, break even. So EBIT margins, they made nothing compared to nothing, even worse, nothing in the year ago period of negative 22.2%. They realized 92 million of tax benefits under the CARES Act, 27 million of pre-tax charges, primarily associated with professional fees. And the company expects to incur total charges of up to 200 million over the life of their acceleration program, including 75 to 90 million in remaining charges, and the rest of those future costs are estimated to be cash. And that's something I would like to see, estimated to be cash costs and recorded primarily in fiscal 2021. 92 million in tax benefits. Going to keep that in the back of my head. Now, right here, you can see the drop in SG&A rather precipitously here. Excuse me. And then the provision for income taxes going negative gave a massive boost to and gave a massive boost to net income. Interest expense going up over 55% in this current year period. These earnings are not the best quality, unfortunately. As a long-term shareholder, like I said, I'm still bullish, but it is pretty ugly right now. Stuart Weitzman, you can see here, broke even. Coach is carrying the company through and through until they can figure out what to do with Stuart Weitzman or just try to sell it off and get rid of it, because that was not the best acquisition they could have done. I hope they can turn things around, and we're going to get to the fun part of this video. You can see some of the working capital going on here. Receivables bloated. I'm going to calculate that out, the growth. Now I'm calculating working capital here as receivables plus inventories minus accounts payable, just to be very clear about how I'm saying it, not the accounting way of current assets minus current liabilities. Receivables grew almost 30%. Inventories grew 10%. Okay, fine. Understandable. Inventories grew, but sales dropped. Net sales dropped for the company 14%. Inventories grew 10%. Net sales for the company dropped 14%. Okay, I'm going to pay attention to that and keep that in the back of my head. And then accounts payables grew. $126. Accounts payables grew 126%. Okay, so they're boosting their working capital by not paying their suppliers as quickly. I imagine that's why accounts payable is up. Could be wrong about that. Receivables grew, so they're extending credit to their customers. And makes me worried about the generous credit terms that they might be receiving, or the lax collection policies that they might be putting in place right now. And then inventories grew slightly. So I'm not surprised that they grew positive free cash flow, because they're holding back money from their suppliers and extending more generous credit terms. You see here, consolidated balance sheet. There's no cash flow statement though. All right, I just wanted to make that quick video on some of my disappointment in Tapestry's short-term results. I'm still very bullish on the long term, but these net income earnings is not as high quality as I would have wanted. But once again, I'm still very bullish on the long term. Not surprised that they had positive free cash flow, considering that they seem to be changing around their cash flow policy, their working capital policy, rooted in the growth of receivables, in the small growth of inventories relative to sales. Net sales for the company, and the boost in accounts payable. I'm going to be paying more attention to the working capital cycle from here on with the company. I want to see how they manage this. I do believe that the new CEO is going to come in and hopefully keep changing the company. But once again, this is still in the game of COVID-19 and seeing how they're going to lead the company through this. I'm still bullish on the long term, but the short term is going to be pretty ugly. Thank you for watching. If you liked the video, please subscribe, please comment, critique with any advice on how I can analyze companies better in the future for better video content. Thank you for watching.